When we hear the word dividend, we may think of a free stream of money given to us from a company for holding their stock. Let's see what Google has to say about them. A quick search reveals the following. The dictionary tells us that a dividend is a sum of money paid regularly, typically quarterly, by a company to its shareholders out of its profits or reserved. Then we also have an AI overview for a simple definition, and that says a dividend is a portion of a company's profits that is distributed to its shareholders as a reward for investing in the company. It's essentially a payment from the company to its owners. After reading these two definitions, it's reasonable to believe that the way dividends work is companies will take a pot of money from their profits or sometimes their reserves if they're not profitable and hand it directly to their stockholders, which would directly increase the value of their stock holdings. But do they really work that way? Let's break down how dividends work to answer that question. As a hypothetical example, let's say we have company ABC, and that company declares a $2 dividend. You own one share of ABC stock, which currently trades at $50. Is your share after the dividend worth $52 for a gain of $2? Below we have the math here. We have the stock price, which was before the dividend, plus the dividend, and then equals the $52, which would be both combined. However, this is not how dividend payouts work. Here's how they work. If company ABC declares a $2 dividend, your stock price will not increase due to the dividend. It will actually decrease from $50 to $48. This happens because the market knows that the company's value is $2 less after the dividend payout, all else being the same. The $2 will be given to you in cash from your current stock position. If we look at an equation, we see the $50, which is the stock price, minus the $2, which is the dividend, equals $48. Now the other $2 are given back to the shareholder in cash. So we see $48, which is what the current stock price will be, plus the $2 dividend equals $50. Therefore, no value was gained nor lost in the dividend process. You start with 50 and you end it with 50. Dividends do not create value. They are not free money. Also, the company chooses the amount of the dividend as well as the timing of the dividend. You as the investor have no choice in the matter. Dividends are taxed even if you had no actual gain in your stock value. However, that is different than a traditional stock in which when you sell it, you're only taxed on what you gained. Companies do not have to pay dividends. Some people may look at companies that pay dividends regularly as safe investments just because they're typically profitable when they pay them. A dividend is not a gain, nor is it a loss in value. In finance lingo, we call it a return of capital to shareholders. Thanks for listening. We look forward to seeing you in our next video.